Tim Mulholland is managing partner at China American Capital Company. He joins us from the CME Group in Chicago and in San Francisco. Michael Yoshikami, he is president and chief investment strategist at YCMNet Advisors, which has about $1 billion under management. He's been the Barron's Roundtable top 100 investment advisors, at least over the last 2 years running, which is why we love to have him on the show. Michael, thanks for joining us. Let me ask you about all of the strategists who've come out with 2011 forecasts, all of them. Thoughts on the economy and Bernie Sanders' filibuster aside, think that the market is going to gain next year. Do you agree?
I do agree. I think the market is primed really to continue its run it's had this year. I think there's just far too much stimulus in the system. First of all, we had Federal Reserve, QE1, QE2, and now on top of that we have the phantom stimulus plan, which will likely add $1 trillion to the deficit over the next 2 years. But the bottom line is we're in the third year of a presidential election. We want to make sure voters are happy, and the way to do that is to make the economy better. And so they're going all out to try to stimulate the economy, and I expect that to be a positive, at least in the short term, for equity prices.
Hey, Tim Mulholland, you buy that too? Are you on the same in the same camp as Mike?
Well, I mean, we've had this massive stimulus, over, worldwide combined over 10 trillion, since the '08 lows. But, next year would be the third year up. So usually in a market off a rebound, sometimes the third year up's not the charm. But, again, we all know the stimulus. We all know that factor. I think that when we're trading at year highs right now, it's kind of hard to say anything but positive. But I think you're going to run into some trouble midway to the end of the first quarter. That's when European problems will probably resurface again. And also this inflation issue in China and the developing world may play a bigger role than people are giving credit for as well.
Guys, I guess it is kind of hard to ignore. I mean, it does feel like certainly things are getting better. You look at what's going on with AIG, General Motors, back being a public company. I mean, it does feel like in some ways things are getting back in order, if you will. Mike, does it kind of feel that way?
Yeah, and I think it feels that way because that's actually happening. I mean, the government actually exited their Citigroup stake with a significant profit. And I do think, as Zara just talked about, I think the financial sector is probably the next to rebound. It's been a lagging market. We have net interest margins that are down, but if you look at the book to value that these companies are trading at, it's very, very attractive. So if you believe the economy is going to get better, and we do believe the economy is going to get better, sluggish, with high deficits and structural problems we need to deal with in a year or two, but if you think the economy is going to get better, I think financials are going to provide opportunities, and they certainly have not participated in the rally thus far.
By the way, you don't seem terribly confident that we'll deal with the deficits and structural problems now. Do you really think we're going to get to them in a year or two, or is it going to be sort of a patch that doesn't really go all the way and cut it?
When I see real deficit cutting action rather than words, I'll believe it. I would not say I'm optimistic that suddenly the government or the policymakers are going to suddenly get deficit fever and start cutting deficits in year 2, year 3, like Ireland or Portugal or any of the other countries that are struggling. So I think there's really a problem here in the United States. I think we have a window at which equities and the economy actually starts to improve. Equities continue to rally. But I think the moment of truth, I think there is a moment of truth coming here, Matt, in the next 2 years. We have to get rid of these structural problems in terms of deficit reduction. If we don't, it's going to be very, very negative for the long term for the country as well as the strength of the currency.
Hey, Tim, it's Julie. How long do you think the markets have before, there's a lot of talk about worries about deficits, but how long do you think the market has before it starts to react negatively?
Well, I think the deficit issue is still maybe perhaps a little ways off, until they can't do an auction. But with the Fed buying, $600 billion, QE2, QE3, what's next? The problem I have, I think, structurally is that this economy really can't get its legs without this massive stimulus. So at this point in the game, I would expect that to happen. So, structurally at some point the deficit's going to come back to haunt. And, maybe it's going to take, surprise in inflation, which virtually nobody expects. I don't know what the issue will be. But my biggest concern is the economy can't go on without stimulus. And I think there's still some skeletons hiding that we may come out. And especially if long-term rates continue higher, that might kind of bring it out a little quicker.
You guys are talking about rates and talking about Fed and all the quantitative easing. We talked to Barclays head of research Larry Cantor on Bloomberg earlier today. He talked specifically about the effect of the Fed's easing plan on the stock market. Check this out.
given all the Fed's done. It's not just zero rates. Right. They bought $1.7 trillion. They're going to buy another $600 billion. We're going to be talking about almost $2.5 trillion in the market. If the market gets a hint that the Fed's going to pull back from this, and I don't think this may not happen in 2011. Right. It's definitely not the first half. This may make 1994 look like a picnic.
All right, Mike, so if the market starts to get a hint that the Fed is getting ready to start pulling back, what do you think? How do you think that plays out in the market?
Well, let's talk about what they're actually doing, right? They're really trying to juice up the system so the momentum can continue. So what's going to happen is that as soon as the Fed starts pulling out, as soon as the Fed starts exiting QE measures, the question really is going to be, is there enough momentum, positive momentum forward in the economy to overcome what the Fed will be doing in terms of easing out of the system? So I think it's going to depend a lot on how delicate, how graceful they are in terms of telegraphing to the market how, in fact, they're going to withdraw the stimulus program that they've put in place through quantitative easing. I tend to believe, given the fact that we really are in a new public relations world in terms of the Federal Reserve here, maybe he'll go on 60 Minutes and actually signal what he's going to be doing. But I think they are going to be cognizant of the fact that the market's going to be watching. So I don't think it's going to be a wake-up one day, they all of a sudden make some announcement. I think they're going to give hints along the way which might make the transition less cataclysmic than 1994.
Well, then they're definitely not printing money, right?
That's what he says.
Listen, everybody's so bullish, or at least everybody is bullish, I should say. But Adam has been looking into some potential dangers for stocks, and he joins us now with some of those. Adam?
Well, Nick Colas, a strategist over at Bank of New York, said he's getting a lot of questions from guys along these lines. Protect me from what if. In other words, what if this whole bull market starts to unwind? What are the risks? And he sort of organizes them this way, the risk spectrum. He says inflation. Obviously, we're even talking about that right now. If there's growth, in theory, there's inflation. PIMCO ups their numbers about growth. Sovereign debt, we talk about it every day. A cyber attack, WikiLeaks. So again, these are all issues at play, even if they're not pushing the market down on a given day. The flash crash, has the architecture in the market changed to prevent a flash crash? And of course, terrorism or a random event like the bird flu virus. In other words, how do you protect against all this? And I've just got to show you guys, here's the S&P over 2 years. Yeah, okay, we know the low is there, but, look at where we are right now. We're pushing towards these 2-year highs. So if you've made all that money, you want to protect it. And I guess, Michael, the question to you is, puts are pretty cheap out there right now. Do you go out and buy puts? You want to stay in the market. You're a bull. You stay invested. Can you justify keeping that as long as you go out and protect it with some puts?
Yeah, I think it makes sense to hedge in this strategy, in this environment. It might be puts. It might be the VIX, buying the VIX, but certainly I think it makes sense to assume that more bad news is coming. It's interesting. It's not an analog decision where it's either you're up or you're down. I think you can be aggressive, prudently so. I think you can go out, invest in equities, but buy the right kind of equities. Buy equities that you think have sector tailwinds, have dividend streams, high cash flow. So if, in fact, a market correction comes back, and frankly, it's inevitable that a market correction is going to happen, you're at least in the kind of assets that are going to help you survive that downturn. You have a little hedging in place as well. And I don't think you put all your money in equities. I think you put your money in other assets that are inflation protection assets like commodities. Gold, even though it's at 1,300, I still think is an opportunity. Oil, other sorts of commodities that likely will do well with inflation. So you want to try to get a little less correlation in your portfolio strategy. That's really the way most investors can hedge effectively.
Hey Tim, I want to bring you back in this really quick, about 20, 30 seconds here. You mentioned China before, huge number coming out earlier than people thought it was going to. What's going to happen with inflation? What does that mean for markets on Monday?
Well, I think the inflation numbers, the risk is it can come in 5% year over year, which is pretty high and moving up. So what it means for the markets is that China, is not going to stop with one rate. There's going to be more anti-inflation measures. And the question is going to be, what effect is that going to have on growth in China, which, as we all know, will affect and impact growth for the rest of the world.
All right. Listen, guys, we got to leave it. Thank you so much. Have a great weekend. Michael Yoshikami out there in San Francisco and Tim Mulholland out there in Chicago.